Have you ever closed out a trade for like 1 hour and it ends up running for 5 hour, 8 hour, or got the perfect entry, held for a 2 hour, a 3 hour, whatever it might be, and then just price reverses and either breaks you out or worse, stops you out, leading to a loss? The reason is you probably don't have a clear view as to where price is targeting. And I am going to hopefully show you a great way to define targets in the market that you can confidently trade to in order to take high probability trades that actually hit your take profit. So before I do that, I'm just going to start with some quick theory around what it is that traders struggle with relating to targets. Then we're going to dive onto the charts and look at some practical examples using Euro USD. So let's get into it. So why do most traders struggle with targets? One could just be arbitrary risk to reward ratio. So you are always targeting a 5 hour or an 8 hour or a 2 hour. It doesn't really matter. You place trades on the basis that you want to hit an arbitrary risk to reward level, not a technical target on your chart. That can run you into problems. It's not necessarily a bad thing to do, but you have to do it within the context of an actual target the price can hit. Two, round numbers. You want to close out profit for certain dollar amounts or whatever it might be. Again, it just doesn't make logical sense. Letting trades run without an exit plan. This is a big one. Just entering trades because you see patterns rather than understanding the purpose of price. And of course, ignoring higher time frame context can get you into a lot of problems when you're not having that understanding of what the higher time frames are doing. The core problem is that price ultimately moves from liquidity pool to liquidity pool and from candle range to candle range. So if you can master the idea of trading candle ranges effectively, you will always know where price is heading. Yes, things can change. New candles can be printed that paint a new picture, but at the time you're executing a trade, you'll have a good idea of where price is currently heading. And that's what we're going to get into. So how to identify trading targets. The core principle is trading candle ranges, and I trade specifically CRT and candle range science. So I'm looking at higher time frame candles and their relationship with one another to create that story of what price is going to do next. So it's about having that want to understand price at a deeper level than just pattern trading or seeing things like structure shifts in the market. Level one of this is price is usually targeting candle range extremes. So when you have a higher time frame bias, you're looking to target the extreme of that range on a lower time frame. So that's your primary target. Level two, you have internal range liquidity points. These are more like immediate targets that you can aim for on the way, as price makes its journey towards those primary targets. There's also things like confluence, so weak highs, the way that liquidity builds in the market. And there's ways to spot that. Equal highs, this is also something whereby there's a level that's previously been respected where relatively equal highs have built. That tends to attract a lot of stop losses that price might want to target. But all of these bits of confluence have to make sense in the broader context of higher time frame targets. So the key question really comes down to is what is the higher time frame intention of price? That will lead you to the price level that you can target. Primary targets. So as I mentioned, the primary target is your higher time frame candle highs and lows. In my mind, the intermediate targets are essentially those mid time frame candle highs and lows. So if you're swing trading, say on the 6 hour, 4 hour, 12 hour, and you're targeting monthly higher time frame trades, then your primary targets will be at the extremes of those monthly candle ranges. If you're targeting that same swing dynamic, then your intermediate targets will sit at things like the weekly high, the 2 weekly high, high and low. So the mid time frame candles that make up those bigger candles like the 1 month or the 3 month time frame. So when we're targeting trades, we want to target either shorter term positions to hit those intermediate targets or larger swing positions to play the entire move. This obviously can be shifted around. If you're day trading, this becomes your maybe 4-hour and daily candles, and then you're executing on lower time frames. But today we're just going to look at swing positions. Just remember, everything is fractal, so you can apply this to lower time frames. So let's get into some chart examples. We're going to use Euro USD. So looking at price action here, there are a whole different host of ways that we could think about understanding what's going on. You could look at the trend lines, the moving averages, whatever it might be, structure, market structure, to determine whether you think price is going up or down and when to exit and enter trades. But ultimately, if we just overlay, first and foremost, the monthly candle, we can straight away get a much better steer of what we think price is going to do. Because what you'll see is that here in this entire box between the 30th of May, or actually it will be the 1st of June, and the end of June, is a range of price action. So here is a range of price action. And then that moves on to the monthly candle, a new range of price action. And essentially what price is doing is it is moving from the extremes of ranges, extremes of higher time frame candles, and drawing back towards the extremes of the opposing ends of higher time frame candles. And what happens right here? So as price is making its downtrend, a new candle is printed. We get this small shift, and price is targeting now the new extreme of the newly created range. What does it do next? It targets the high of the range that it is liquidated. And then we liquidate the high of this range. And so we start to make a downtrend in the market. We run, this candle closes the low of this candle, so price can continue lower. We then liquidate the low of this candle's range, and we head for the opposing end of that candle that was traded below. So we've traded back to the range high. So we are just moving from liquidity pool to liquidity pool and so on. And our job as traders is to understand the relationship between these candles, to start piecing together other parts of technical analysis to target areas in the market that we think price is being attracted to. So with that being said, what we can do is go beyond simply understanding where price is drawing to understand the structure in the market. And you can do things like look at structure shifts. So you've got this price leg bearish coming off this price leg, and then you see a market structure shift whereby we get a close above this price leg. Price then mitigates a fair value gap at this level and then proceeds higher. So we can start to think about trading these legs in the context of understanding where price might want to target next. As soon as we get a liquidation of this higher time frame candle right here, we get liquidity swept below this low, and then we get that structure shift right here on our execution time frame. I'll just mark that in a different color so that we can see it. And then we have a new price leg with internal range liquidity that we can use to target higher. We can start looking at trade opportunities. So for example, if you wanted to take the fair value gap right here, maybe cover the liquidation of this low and target the high, this would be your swing target from this position, because you know you're liquidating below a low, you've seen a shift, and you have a primary target that you can use to execute your trade. Now, that's step one, but what we want to do beyond that is understand the relationship between our primary targets and our intermediate targets, and we can use the exact same points of liquidity to take trades and to understand flaws in the market. So knowing that we've had this shift, that we have a liquidation of this low, we can have a very good steer that we think price is going to draw towards the high. So it's about one, understanding where to execute from, why, and ensuring that we're targeting the right areas in the market. And you can see the next thing that happens is that we get this liquidity building on the weekly time frame right here. And then we get the same thing happening on our intermediate time frame, where we have this week's range. So if I just take away the monthly candle quickly, you can see all of the weekly candles that sit behind this time frame. We're looking at this specific candle. I'll add the monthly back. And what happens essentially is that we get a liquidation again of the candle's low. And then what happens? We see that price doesn't close below this price leg, even though it looks as though there's bearish action. We then get new bullish action, and we get new internal range liquidity that we can trade from. We get the formation of an order block, which we can take a trade from. And now we have information. We have two targets. First is the high of the candle that we initially liquidated, our intermediate high. Because we've seen accumulation candle, liquidation of the low. So our intermediate target is the weekly time frame or the weekly level. But we also have the context that we can target the high of the candle that we've liquidated, our primary target. So price is looking to do that essentially. What we can then do is mark on our structure. So here we have a 12-hour order block right here. And so it becomes a case of then entering trades based on structure, internal range liquidity, where we have multiple targets. We have first and foremost our intermediate target, which is our weekly high right there. And then we can hold these targets towards our primary targets, which are at the previous monthly candles range high. And that would be a 2.4R trade. So that's the premise of tying together candle ranges and understanding the relationship between candle ranges to effectively target key liquidity areas in the market. And if I just shift this now onto the 2-week time frame, and I will just give you another view as to another intermediate target. What can we also see? Well, if you notice here, there is within this downtrend, there's half of this 2-week candle. I'll move this away. So we get bullish candle, we then get retracement, and then as soon as this candle closes and we get this market structure shift, we've also manipulated this candle right here, this 2-week candle. So when we're placing this trade, yes, we have the weekly candle as our high, but we're also playing out a 2-week candle CRT, whereby we saw a accumulation candle, manipulation candle, manipulating the low, close inside with a structure shift right here. So the next logical target for price beyond all of this consolidation is actually this 2-week high right here. So that becomes our second intermediate target. So any trades that we're placing in this area, as soon as this candle closes and we have this liquidation, anything we're looking to get involved in, all of this is noise. And just tracking higher time frame candles, we have monthly high, 2-week high, and weekly high. So these are our technical targets in the market that we can target. And these are 1.2R, 1.84R, and 2.37R. As soon as we then get that shift above, then arguably you should just take all of your profit at this level. But if you did want to hold to see what happens next, you could do so, but you want to then start managing your take profit to make sure that you're not then getting sucked into a downtrend in the market that might want to stop you out. And the reason for that, which we'll go on to see, is that as soon as we then get that shift higher and this candle closes, we have a liquidation of this candle. So the next logical target for price becomes our new primary target at this range low. This monthly range is low because we've seen accumulation, manipulation, and now we're looking for distribution down to this liquidity pool. The reason this is a strong liquidity pool is because everyone that wanted to target this high has stops in this area. So that is where a lot of resting liquidity in the market exists. So again, we can do the same thing whereby we map our structure. I'll just use this as a more visual representation. So we have the up move that occurs off of this leg here. Then we come down, we get a reaction, then we actually get a shift. As soon as we've seen that shift in there, we can then have our first indication that we might want to trade lower. Of course, we get additional shifts in here that give us more confluence. So you can start to think about trades short. And again, you'd be doing the same thing. So you've got an order block right here. This is a 12-hour order block, a bearish order block. So you might want to look at trading from that order block towards our next primary target, which would be a 5.34R trade. Now, this does not play out. And the reason for that is that once we get a close of this candle here, we then get a new sweep. And again, what we can do is start to overlay higher time frame candles onto our chart to understand where price might be targeting next. So here we have the 2-week chart. We can also add on, to get an even more granular view, the weekly chart, to get a better guide as to what price is actually doing. And you can see, if you look here, in the close of the monthly candle, we have a weekly range right here that gets traded below, it gets swept. So this level here is being swept. So the intermediate target for price could be this high, at the high of the weekly candle. So price is trading below. The reason that we don't get such a clean CRT is because we don't need it, because we're sweeping below the monthly low. Then as soon as the monthly low, the monthly candle's closed and confirmed, and we've seen that sweep, look how fast the actual move whereby price seeks that high happens. It's very quick. Within just 2 weeks, we've targeted that level right there in the market. So coming back to how you would trade this, you then need to track the price legs in this range here. This is getting a little bit messy. Obviously, you wouldn't leave all this structure here. It's just for the purposes of actually running through the theory here. But you have highs being respected. Then you get this sell-off. Then we get structure shift right here. So we're getting confirmation now that we're sweeping that low. And then we get a touch into the internal range liquidity. And then we have our first intermediate target right here. And then we have our primary target right here at this level. So from a swing point of view, you could enter at the fair value gap and cover below the order block right here. And that would be a 2R to the intermediate price target and a 4.2R to the swing target. And what you can do in addition to this is start to track price legs. As we extend, you see that if I just remove this, we get a bullish weekly close right here. So we've closed above the previous candle, which would indicate we're going to find support in this candle. So then you can do the exact same thing. We have a fair value gap right here at this level. So even like a very conservative trade, cover the weekly low, for example, and trade back towards your primary target at the high, 2.3R. So you've got 2 trades in there. So it's just understanding the relationship between candle ranges as they print, understanding how your intermediate time frame corresponds with your ultimately higher time frame in association with the price action that you're trading, and when you're entering positions, ensuring that you have the right candle context and that you're targeting the right areas in the market. And if you can start to layer these things on top of each other, then you will find that you'll not only hit a lot of wins, you'll also get a very strong win rate, and your R to R, your risk to reward, will be very good, because a lot of the swing positions you can take will be plus 2R. The final thing to say here is that if you do have a fixed R trading structure and you just want to, for example, trade 1-to-1, you can do that, but just always make sure that, assume that's 1-to-1, that you have enough room towards your intermediate and primary targets to hit your fixed R multiple. What you don't want to do is have like maybe a 5R multiple that you always trade towards, and it's right up here, because what you're seeing is that you're going to take out this high, price might just retrace, sweep this level and continue lower. So you're always needing to trade within the context of the candles that you have access to seeing. So that's the premise of primary and intermediate targets in relation to higher time frame candles and trading candle ranges. Why targets don't get hit? Usually there's a shift in higher time frame structure. So for example, we had a liquidation of this candle range. We were aiming to take out this low here, but as soon as we saw this candle get printed, the structure shift and the rejection of this low, we knew that actually price wanted to go higher. So need to be aware of shifts in higher time frame structure so that we stay on the right side of the market. And that's the same thing, opposing higher time frame CRTs. And I have a whole host of videos on CRT trading that I urge you to take a look at. So trading target must-haves: clear view of higher time frame candle ranges, sight of primary and intermediate targets. Every exit of a trade is an entry of a trade, so look to take trades from liquidation of lows and structure shifts, then have a clear exit plan ahead of entering a trade. Always trade from structure and always control your emotions, especially when you're swing trading. When you see these sell-offs in the market, don't get duped into losing your position, because you know price will eventually find structure to target these higher time frame objectives for price. Trading target common mistakes. Setting arbitrary targets are okay, but arbitrary targets like fixed 2R or fixed 3R, they only work if they're sitting within the context that you can hit. Aiming for targets that don't align with higher time frame structure, that's the exact same thing that we're talking about. Don't look for 5R trades that don't exist. Don't change targets mid-trade without confirmation. So wait for structure to confirm before you start changing your targets, and never ignore structure. So that's been a whistle-stop tour of some of the core foundations of primary and intermediate targets, but we've looked at quite a detailed view of what's actually been happening on Euro USD from a liquidation or a liquidity standpoint, whereby price has been liquidating higher time frame candle ranges, showing you the intention of price. The next step then is just understanding how to trade it. Please subscribe. I'm releasing a lot of content that looks at all the different aspects you need to become a profitable trader. And I'm also releasing a lot of content looking at what's actually happening in the market from a swing point of view right now. So yeah, see you on the next one.